Well, gold rose to another record today, and the commodity complex is testing a two-year high. Rob Russell, who's the president of money management firm Russell & Company, joins us with a closer look at gold and other matters as well. Welcome to you, Rob. Good to have you with us.
Oh, it's my pleasure. Thanks for having me.
So you got in at gold when it was about $700 an ounce. We're looking at it now, not quite double, but not too far off either. How much longer do you stay in it?
Well, that's the real tough question, and it's something you have to be fluid with because it tends to move with the news, the macroeconomic news at least. And I think, with the Fed hinting again about QE2, that makes the case for at least a bullish sign in gold, because anytime they do the QE, any kind of quantitative easing, it's lowering, it's devaluing the U.S. dollar, and what does well during that time period? It's the precious metals, gold, silver, so on and so forth.
There are a few lenses that people view gold through, and certainly currency seems to be the dominant one. What other lenses through which do you view gold?
We use it as a hedge, also as a hedge against the U.S. market. The market has done very, very well. That's why you've seen actually gold rise in lockstep with the U.S. markets, the indices. And so people are doing that because they don't know if the floor is going to fall out. Look, if anybody's been invested in the last 3 years, they'd be foolish not to at least consider there could be another market downturn. And so while they're happy the market's going up, they're also hedging that bet with gold and silver.
Now, with oil, we've got tons of it around there. We've got an inventory report that shows inventories really didn't sink as much as a lot of people thought they might. What's your outlook for gold? Do you stick with the really long-term picture, or are you more concerned about the short term?
And did you say in terms of gold?
Oil.
Or oil?
Yeah, oil.
Oh, oil. Okay. So in terms of oil, and that's certainly part of the basket of commodities we use as the risk portion of the client's strategy. Oil, you're right. We're pushing some newer highs here, at least recent highs. And it's one of those things where I think you could actually take some profits off the table when the time is right. And we'll just have to continue to monitor the situation. Again, that too, commodities, the interesting thing about commodities, they're very, very fluid. And you have to stay on top of them. Even more than I would say with stocks. But commodities move in different circles like currencies. And you just have to stay on top of your toes.
A lot of people looking at what they seem to be calling non-dollar plays, particularly with the idea that QE2 is somewhere in the pipeline, not so far from now. Obviously, gold is one of them, commodities, again, others. Also, emerging markets. How do you play emerging markets? And you also like emerging markets. Maybe you can tell us what you mean by that.
That's right. Again, part of the equity exposure for clients, I like what I call emerging markets. Those are the emerging markets that have yet to blossom or even been found. When you think of Asia, typically you think of China and you think of India as the emerging markets. Well, what about Indonesia? There's a great example. Indonesia has the second best performing currency in all of Asia and the largest economy in Southeast Asia, the fourth most populated country in the world. GDP's is 6 to 7% range. Unemployment is lower than what it is here in the United States and going lower. So there's a little gem there. Chile, you've heard a lot about Chile in terms of the miners being rescued. But from an investment standpoint, they have the lowest corporate tax rate in all of Latin America, a great GDP growth, again, unemployment heading in the right direction, and so they have great growth prospects, and you can play those countries, or you can bring it back to the U.S. and buy the U.S. companies that provide the machinery for the infrastructure growth in the emerging markets and the technology behind that too.
Of course, Chile getting lots of extra attention for people to be curious about its economy right now. You're also pretty much out of bonds. When did you start that move?
Absolutely. Yeah, we started selling off because think of it this way. How do you make money? Investing 101. You buy low and you sell high. Unfortunately, a lot of investors do the exact opposite. They're their own worst enemy. So we were selling bonds at a high a year and a half ago is when we were exiting the bonds. And specifically the medium to long-term maturities. You hear the talk about the bond bubble, and that's, there's some evidence there. Interest rates here in the U.S. are near zero, which means bond prices are at an all-time high. Now is the time we should be exiting that space. We sell high, and that's what you want to do. For instance, 1% increase in interest rates could send a long-term bond price down by 15%. There's the risk. Now, is interest rates going to move anytime in the near future? Well, maybe not tomorrow, but maybe in the next year. The Fed's already hinted at that as well. The key here over the last few years is to see what the Fed is hinting about and then using that to your advantage. And that's why it was a smart play in gold. It's a smart play, in my opinion, in our opinion, to protect our risk-averse clients, to be out of bonds and look at other opportunities there.
Well, hints have certainly worked for a little equity rally that we've been taking a look at here, too, haven't they? All right, Rob, we'll have to leave it there. Thanks so much for your thoughts.
My pleasure. Take care.
Rob Russell is the president of Russell & Company.